Good morning, everybody. I hope you can all hear me. It's David Bundred, and I'm the chairman of Surface Transforms, welcoming everybody to this presentation on prior to the open offer, as part of the open offer process that's been facilitated by our good friends Hardman and Co. What we're going to do is a presentation, which I think will last 20-25 minutes, something like that, followed by a question and answer session that'll probably last about 45 minutes, give or take. I now want to introduce the people who are going to do the presentation, and it's going to be Kevin, who's well known to many of the shareholders, both old and new, and the new team, Isabelle's been on one of these presentations before, but it's new for Stephen. Isabelle and Stephen, as I said, a new team, joined us 6-7 months ago, something like that. Like all new teams, takes a few months to get your feet under the table and get started. Isabelle joined us from James Cropper, has got a long history of PLC experience. Stephen has had over 26 years of experience in manufacturing operations in the automotive industry, and more to the point, in carbon ceramics. He actually joined us as being the UK managing director of SGL. So what I'm now going to do is hand over, and I'm going to ask to pull up the presentation here, which I see is done, and hand over to Kevin, who will lead the presentation. And so over to you now, Kevin.
Thanks, David. So as David just said, look, we're conscious we've got lots of questions, and we'd like to spend hopefully the majority of the time we've got, which is about an hour, answering questions and doing all the Q&A. So we're going to try and get through this presentation in about 20-25 minutes. And if I could just start by reminding everybody, perhaps I know some of you will know us, some of you might not know us as well, but perhaps just start by doing a brief introduction to what we do, where it fits into the marketplace, and what the history of the company is. So as a company, we make carbon ceramic brake discs for the automotive market. For those that don't know, the brakes on a car are a safety critical feature. They actually allow the car to transform all that energy that's built up from the powertrain and then dump it into the brakes. So it's a high temperature, safety critical, complex system. And what we're interested in within that complex system is the brake disc. And the system itself is made up of a caliper, brake pads, and a disc, and the brake pads squeeze onto the disc to make it stop. And what we found over the last sort of 2 decades is that the limitations of iron brakes, which has been the incumbent technology on cars for the last sort of 40-50 years, maybe even longer, is that cars, as they've got heavier and have got more acceleration and speed, that's pushing the limits of the iron brake technology, and that can fall over because the energy involved is just overheating the iron brake. You don't have that issue with ceramics. They'll work whether the car is high acceleration, high weight, high energy, and it'll give you consistent braking throughout that profile. So there's a benefit by swapping out the technologies from iron to ceramics, just from the needs of the marketplace in terms of the weight and speed of the car. Not only that, the trends are getting further and further that way with electric vehicles. There's a trend here with electric vehicles being even faster, even heavier because of the batteries. So there's a bigger driver to look for weight saving as well as the technology for brakes. And weight is a big driver on all the car. And we talk about weight saving for a ceramic brake disc, which can save typically about 25 kilos by just swapping the disc out. But if you multiply that up, because this is an unsprung mass within the wheel, you can start to strip out weight on the uprights, the suspension, and so forth. So we talk about saving up to 100 kilos per car. And that's about 5% of the weight of a car. So by just changing one technology, you can get a 5% benefit in weight, which is hugely significant for any automotive vehicle manufacturer. The next part, if you like, of the product offering is its emissions. With that weight saving, we obviously save on emissions from the car. We can obviously save on battery weight or give it extra range for electric vehicles. But it also has the feature with electric cars where, with the emissions in the engine being eliminated, the next biggest pollutant is the brake pad dust and the wear from tyres on the car. And there is a legislation coming in the coming years, which is really pushing the technology on brake systems to reduce the emissions from brake pad dust. Now, ceramics, with the way they work, can actually reduce the pad wear and therefore the pad dust by about 50% and bring them inside those new limits that are coming in. So there's another driver in terms of an environmental aspect to move over from iron to ceramics. In terms of the landscape and the technology, it's worth noting that there's been one major supplier in the marketplace, a company called Brembo SGL. Indeed, Stephen, who you've just been introduced to, is familiar with this. Now, they've been the dominant player and have driven the adoption of ceramics, but it's very unusual for an automotive market to have only one player. They normally like to have at least two, not least for competition, but also to build capacity. So the market's been trying to pull through an alternative supply, and with our superior product and our positioning where we've been adding capacity ourselves, we've been well placed to take advantage of that. So with all of those product benefits, with the position in terms of the marketplace and the customers and the landscape of competition, we've been able to make our product offering, which is recognized throughout the industry as being superior. And that's to do with the way we make our products. So not all carbon ceramics are the same. We liken our product to making long fibers and giving it strength like plywood versus our competitors who chops up a fiber and makes chipboard, which is a lot weaker. And we have much better thermal properties as well, which is integral for a brake disc. So all of those trends have meant we've been increasingly successful in winning customer contracts. And we've been then focused on building our advanced manufacturing facility. We have contracts in place for 390 million lifetime. And we have a pipeline of 300 million as well. So our job has really been focused on then capitalizing on those contract wins and start to develop and expand and grow the business through the advanced manufacturing process we have. So look, I think that hopefully gives everyone a very, very brief introduction. I'll then hand over and pass it over to where we are in current status team.
This page is our immediate roadmap to growth and financial stability. Because whilst we've encountered unforeseen capacity and production challenges in the past, we've factored these into our revised business outlook going forward. So these KPIs on this slide are the KPIs that hold the most weight for our current stage in this company's growth phase. The black bars are very much the past, where we've had these unforeseen challenges in capacity, in production stability, in yield, and in cost. And all of those have had an impact on our sales and our cash. And the yellow bars are our targets for this quarter, and our grey bars going outwards are our anticipated trajectory against all of these KPIs. These are the KPIs that are critical for accelerating performance and accelerating growth. Now I'm going to talk very briefly about the revenue page here, and then I'll hand over to Stephen. So the revenues that we're sharing here are the revenues against our low case business plan. This is the bottom end of our forecast range, being 17.5 million for 2024 and 28 million into 2025. Now, a couple of people, I think James Humphreys and Daphne Morgan, have asked questions about our break-even position or cash burn. So let me just address that in the context of this quarterly revenues here. So when we get to Q4 in 2024, anything between 5.5 and 6 million a quarter gives us an EBITDA break-even, if you like. We turn into EBITDA profitability between 5.5 and 6 million each quarter and thereafter. In terms of cash burn, I look at that, and we probably all look at that very differently, because it's more than just operating trading performance that we see through EBITDA. It really matters from our working capital point of view. So in terms of cash burn, whilst it ebbs and flows each month because of those dynamics of working capital, we get to a state of certainty and no longer burning cash on this low case business plan in Q2 of 2025, next year. So thanks for those questions. Now Stephen's going to unveil a little bit more of the details behind our strategic adjustments here for the other KPIs on this page, and I'll hand over to Stephen.
Okay, thanks, Isabelle. Yeah, good afternoon. Yeah, I'll take you through the remaining sort of portions of this slide. I'll probably best start with the effective capacity revenue. So that's the chart just below the one that Isabelle's talked you through. It basically what it spells out is our effective capacity, and by that I mean it includes an OEE figure. And for those that maybe don't know what the OEE calculation is, it factors in things like capacity, performance, and quality. And it's a multiplier effect as well. So it's particularly sensitive. If you can imagine that you're not at 100% for any one of those key criteria, then it can have a fairly large impact on the result. So probably what you'll already notice is if you check off the yellow bar, for instance, we've got 4 million for quarterly revenue for this quarter, but we've got an effective capacity of 7. And that's really just to bake ourselves in a bit of headroom there, because as I say, it's heavily influenced by the availability of the equipment. So in terms of our maintenance of the equipment and whether it's able to be on or off. Also our performance in terms of run-at rates or throughputs of the production process, and also quality. Maybe jumping across, just because I mentioned quality, the manufacturing yield chart that's in the middle there tells you a bit of a story, tells you a few things. Clearly, we were not where we needed to be last year. We had around about 50% scrap rate. Good news is already in the first quarter, we've realized a significant reduction in that. So it's halved, so it's around 25%. And what we've done for the rest of this year, you'll see, is not been overly aggressive, I would say, in terms of how we can reduce that. Clearly, 25% in any manufacturing business is not a number that is satisfactory. So we are targeting, you'll see in the outer years, sort of 1-2%, but it will take us time to get there. There is in any quality and yield opportunity to improve the yield, there is a kind of Pareto effect. So what we have seen is that we've got a few standout headline acts, if you like, that we need to address. So we've looked at the top 5, we've addressed number 2 and 3, and we're working heavily on number 1. We have made an improvement, and we feel most of the improvement that will come through Q2 is a reduction in that. And we'll continue to do that as we go through the rest of the year. But of course, as you start to get into the tail of the topics, things get a little tougher. But the business model's been baked and business model's been built around these figures, essentially. The chart just above that, the production stability, what we've tried to do is give a little context, I guess, on the journey. So in terms of where we've been and where we're going to. As any scale-up business, there's a lot of change. Whether that's people, process, equipment. And the number 72 you see there as an average for 2023 is really the number of key process and equipment challenges or critical changes that we've had in the process. You see in Q1 also we've had a lot, 42. It starts to tail off as we go into Q2 and beyond. There is a bit of a blip in Q4. Reason for that is we've got another key piece of equipment coming on stream then, which is CBI 5. So it's really to account for that. But what you do see is a sort of steady tail off. And really, it's to sort of, like I say, bring a bit of context, hopefully, to the journey of where we've been and where we're going to, and to show that the challenges definitely get less. There are still challenges. There will always be challenges with any manufacturing business, but they do tail off and as we start to address those. And lastly, just looking at the cost reduction savings chart at the bottom there, the negative bars for looking at the previous year in 23 and the previous quarter are really negative because of 2 principal reasons. One is energy. So we moved into a new energy contract early part of this year, which is a much more favorable price point for us, both in power and gas. And as you can appreciate, it's a largely a thermal process. So it's governed heavily by energy costs. And also in Q1, we also had obviously some capacity constraints, which is restricting our potential run-at rates, if you like, or throughput. And as you start to see, we believe there's quite an opportunity to save on costs. Again, we're not baking in too much this year. These are largely linked around incremental improvements in throughputs through equipment improvements and adjustments, and also some key equipment that we'll be bringing on stream later this year. So yeah, hopefully address most the sort of content of this slide. I guess we'll pick up in the Q&A as well any other additional points that everyone has, and I'll jump on to the next slide and hand over to Isabelle.
This slide is very much a looking back slide, because way back in October, November last year, we went out to raise funds, and we called it Project Optimus at the time. And this helps us to articulate where the differences are, because there are significant differences that we've touched upon. Because we did raise money, and we raised money for working capital, not for CapEx, and we've used that. So very much in terms of the top 3 bullets on this slide, this is explaining effectively what Stephen talked about in terms of where we are and what we need to do going forward. We had capacity constraints in terms of getting equipment in, getting it online, getting it available, and then making good product from it. And those constraints are now overcome and addressed. We have a project manager's office that deals with all of that. However, during this 6-month period, we effectively lost sales and 1.5 million of planned contribution from those sales. Yield has really hurt us. Our yield was very low last year. And even though we've seen significant improvement this quarter, during this 6-month period, we have incurred 2.5 million of cost from our yield being much lower. And of course, we are addressing that now. We've got this roadmap that gets us through to a 99% yield over the next 2 years in terms of where we need to be. However, right now, and what we've experienced, we've lost 2.5 million from both lost sales and contribution. And then equally, during this period of significant process changes, remember that top graph in the top corner there, we incurred a high amount of development costs. And development's more than just failed products, about process improvements. It's about improving a machine at a particular stage, whether it's the turnaround time on a machine, or testing whether discs or rotors should be ground from the top of the side. All of that incurs tooling, labour, consumable materials, and there was a high amount of activity, and we've incurred 1.2 million of development costs. So those top 3 bullets are 5.1 million, which are non-recoverable. The bottom 2 bullets are very much 1.6 million. These are all to do with timing differences. There was Martin Harris, you asked a very specific question on the 3.5 million. The 3.5 million timing arose from the loan. We originally anticipated some reimbursement of past CapEx, which I think is what you were alluding to, whereas our loan facility now focuses on future CapEx. The drawdown profile is very different. It is indeed actually more beneficial to us because it is a forward-facing facility, and that means that 100% of all capital expenditure is paid as it's incurred over the next 2 years. So to answer your question, the loan is for all future additional CapEx, and by Q1 2024, we've tested it. We will have drawn down 1 million in the first quarter of this year. It's now actually increasing at quite a pace, and we have that 13.2 million to enable growth-enabling investments over the next 2 years. The 1.9 gain is the reverse of that. If as sales were not as anticipated in January and February against those original plans, that there's this saving in terms of working capital, and we're now seeing that unwind as we've got significant amount of WIP, and debtors are increasing, and we're feeling the pinch. So previous communications, I think it was Alistair Graham mentioned, we've said this before, we did lead shareholders to believe that this was the past fundraisers would be the last before achieving free cash flow. And this has not been the case. The business has encountered challenges that were significant in terms of capacity and sales performance and manufacturing costs, and they differed from our initial projections. We have now a developed, revised business outlook, and that addresses these key drivers that are absolutely necessary to turn our business around. And as we're turning that around, we will do achieve break-even in Q4 of this year from an EBITDA point of view. And as I mentioned earlier, we are turning cash burn into a cash positive situation in 2025.
So look, as part of what we've needed to do, we have Project Bumblebee, and that was a proposed placing of 6.5 million with an open offer, and that's what we're presenting today, the open offer. And really the requirements for that placing is, as Isabelle's just explained, there was an immediate need for working capital requirement to support the operations and the continued scale up of the business. And what we must do now is build on that. We've got that placing in play. We are going through the open offer. And as Stephen's highlighted, it's about improving our yield, moving the company forward with its manufacturing capacity into a positive EBITDA situation in the near term, supporting those 5 contracts that are now in the series production multi-year phase of cash generation. And also very important to us is the cost reduction plan that's advancing well this year. We expect it to continue to advance well. In parallel with that, we then need to continue building our capacity. And we talked about this in the past, where we talked about building our capacity at 50 million and then 75, because we really do want to get ahead of the curve. And the good news there is that we have the debt finance in place to support that capital investment. And it is then a case of building it up to support the contracts that we've already won. So what I'd like to do now is just hand over to Stephen again, and he can talk about how we're progressing with that manufacturing capacity.
Okay, yeah, as you see in the slide, it's in 3 phases or across 3 phases essentially. So phase 1 being the here and the now, so capacity being in place for up to 20 million revenue per year. That's installed production capacity, and that's including our OEE assumptions that are baked in there. And again, with OEE, it's factoring for things like availability, performance, and quality or scrap essentially. Moving into 24 and 25, that's phase 2. We step up from 20 million revenue to 50 and then 75. So again, quite a kind of leap in terms of the ramp up, all financed through the RDF funding loan that was just discussed a moment earlier. So we've got close to 14 million, and we've got all of that kind of, if you like, carved out and spent. We know where we need to spend that cash. We've got the equipment and the improvements all planned, and orders in place for the majority of that. As you can appreciate, a lot of this equipment has a certain lead time, so this equipment is kind of in hand and on order. And yeah, we are more than confident that we'll reach those targets through the end of 2025. And then beyond that, obviously, phase 3 takes us up to 150 million. Additional investment will be required, but self-financed from there on. And yeah, that will take us through till 2027 timeframe and beyond. In the interest of just trying to get to the Q&A piece as well, I think I'll keep this kind of brief, and I think that's the main key points on this slide. And yeah, I'll hand it back. Thank you.
Thanks, Stephen. So I thought I'd just talk a little bit about customers, because we've had a few questions come in, and we can take those questions as part of the Q&A from Alan, Patrick, and Nathan. But I just wanted to also reassure everybody that we still have our 6 OEMs, we still have our contracts in place. Those contracts we measure not only in terms of winning those contracts, but whether they're follow-on contracts. And so we still have good success in once we've been engineered in, and there's that power relationship between us and the customer is one of collaboration and partnership, because they need us once they've awarded the contract to be engineered in. It's too expensive and too costly in terms of time to change from one technology to another on a braking system. So we do look at follow-on contracts once that's designed in for the parts bin and so on. And there's an incubation period, to remind everyone, between winning those contracts, typically 2 to 3 years before they then go into series supply. So currently we have 5 in series supply. We are supporting all 5 of those contracts with our current capacity and our current capabilities. And we've worked with all of those customers very closely to reschedule their demands based on what we can achieve. And everyone is on board with our plans going forward in 2024, 25 and 26. And we'll see an additional contract come into series towards the end of this year. So that will bring us up to 6 in series by the end of the year. And then the remainder of those 12 will come on stream through 26, 27 and into 28. And then just remind everyone that although we've had our challenges on building that capacity, the lifetime contracts are still there at 390 million. which equates to just under 80 million in terms of an average once they're all in series. And then with that pipeline of 300 million, which equates to 50 million on average per year, if we convert it into contracts, those two added together come to just under 130 million. That's what's driving our plans for capacity when Stephen talked about the phase 3 capacity plan requiring us to get up to 150 million capacity, because we can see where our customers are going with the product, and we can see where the market is going with the demand. So I don't want to spend, and I'm conscious of time, we're almost at the end here. So if I just move on to the last slide, the summary, and I try and summarize it for everyone, and then we can move into Q&A. So look, we are continuing to build our effective capacity up, and that will drive us into positive EBITDA in the near term. And the key components of that are delivering to those customer contracts that are in series, building that yield up progressively through the year, and advancing that cost reduction program to support our gross margin. Alongside that, it's about capacity and implementing that phase 2 capacity in 24 for the 50 million and 75 million 25. And just to remind everyone, that is supported by the debt finance that we already have in place with our ERDF loan. And then from the customer's perspective, those customers are with us. They work very closely with us. They've seen these, if you like, disruptive scale-up technologies before. They are familiar with how they work and whether there are risks in scale-up. And they will help us along the way, as they've already done. And it's about turning all of that capacity into the revenues to support those contracts as we go forward. So hopefully that gives everyone a bit more colour of what we've been doing and what the challenges we've been facing and how we've been trying to address them. I think we can move into the Q&A.
Okay, thank you, Kevin. I should have made the comment at the start. I realised and frankly forgot. This slide presentation will be going on the company's website probably this afternoon. So there will be an opportunity to look at that in more detail. Firstly, thank you very much for the large number, the huge quantity of advanced questions. It helps us to structure it, but do keep the questions coming in. I see we've got about 15, 20 questions that have come in. Inevitably, some of these are duplications, and I see one or two advanced questions have also come in on the site. Do keep them coming in. There is a generic point I want to make before we go into it. A number of the questions ask for more detail about monthly numbers. We've said on a number of occasions, we think it's genuinely unhelpful to investor relations and share price to do monthly updates. We're doing quarterly updates. Frankly, there's just simply too much noise and too much day-to-day factory stuff in monthly numbers. We'd spend more of our time explaining that than we were on getting on with the business. So we're not going to give monthly updates. And before I go into the actual presentation, we think we've covered, and I hope this statement is helpful, we think we've covered a number of the questions in the presentation, but we're still going to answer those specific questions, even at the risk of duplication. We don't want to be no doubt that people feel they've had the questions answered. And in that regard, what we're going to do is we've grouped the questions into those broadly covering finance. So we'll kick off with a number of questions that Isabelle will answer, a number of questions broadly covered by operations that Stephen will answer. We're trying to group them together to make it more efficient, candidly. And lastly, there's customer stuff where Kevin will answer. There's 2 or 3 questions on that, and some shareholder reassurance. So let's get started. And I'm going to, having just said how we're grouping it all, I'm going to deal with the first question myself. That's actually come in from Charles Breeze, a very old friend and long-term investor. And it's about the process for replacing me. The question is an executive search firm being used for finding the incoming chairman? If the answer is yes, what experience does the firm have and what sort of person? So let me just talk about the process. I mean, firstly, there are both, as you'd imagine, in fact, one of the last discussions I had with Charles on this was about planning for future, planning for the future some time ago. So there are internal candidate, but we want to make absolutely sure that we've got the best person, and we're using the people who actually we've used in the past who specialise in finding NEDs, and they were the headhunters who found all the current team actually, who found Ian, Matthew, and Julia, and we're happy to use them again. The profile of the person being targeted, it's there's a profile out there actually, but I think, to be honest, I'm more concerned about, I think we collectively are more concerned about getting the right type of person. So we are looking for somebody. There is a process. It's a professional process. It's being run by a professional company, and I'm sure there'll be a good outcome. So with that, having got rid of that stuff, let's move on to the finance questions. Isabelle, I'd just like to, although you've answered the question, and a lot, this will be on a number of the times. So let's say it again. I mean, James Humphreys, what income is required for surface transforms to break even? When do you anticipate? Just repeat it, please.
Well, break even from an EBITDA point of view, we need to be between 5.5 and 6 million. Yeah, and that matters to get steady, reliable EBITDA. As we grow, from break even from a working capital and cash burn point of view, we need to we'll achieve that in the middle of 2025 against our worst case business plan. Yeah.
Okay, and another one from Colin Hughes. With the funds raised, do you have a buffer if production falls short of your expectations again?
Yes, yeah. Colin, we did a number of scenarios. Obviously, it's important to build in a buffer. On our core business plan, which is actually greater than what we've presented here, because we gave a range. Our buffer is about 3 million throughout the next 24 months. However, on the low case, you should know that the lowest point, it tips just below 2.5 million, round about the middle of 2025, and then recovers again. So we've got a 2.5 million buffer against our low case business plan.
Okay.
On the 6.5 million raise, excluding open offer.
Yeah, there will obviously, because a lot of the projections, and even the note that's come out this morning, I should refer to that as well, note that's come out this morning from Hardman, are all based on the placing, and we haven't yet factored in any monies we get from the open offer. So the open offer will be further headroom. That's the way we see it.
Correct, exactly, yeah.
There's a question from Martin K here. What steps are being taken to conserve cash, given the proximity of the last cash raise was supposed to last until break even?
Yeah. I mean, it's a good question, because we're always acting to conserve cash and manage our cash really tightly. So all the normal things you'd expect from a business, basically no unnecessary travel or office upgrades or marketing campaigns. It really is about every single type of expenditure needs to align with our production goals, needs to align with those key KPIs, and are we getting a return on those KPIs? And that's where we really focus our expenditure plans. I'll just add to that we have a couple of other things to enable and free up our cash flow. So we are in talks with both our suppliers, our debtors, and our banks to optimize faster payment options or to ease on payment options to give us resilience in terms of our cash flow as we grow. And finally, I think the really important thing to emphasize as well is that CapEx is ring fenced. So that's protected. We've got the loan, and that's for our funds are used to grow significant investment in terms of our capital plan. So we're not using any of our free cash flow for investment. That comes from the loan.
Yeah, I'm glad you've emphasise that point, that the CapEx is ring fenced. I'm not entirely sure that all the shareholders, both old and new, completely understand that. And we've got all sorts of problems, but funding for CapEx is not one of them. I think the last question, and we'll take the generic one about is this the last fundraise? I think we'll take that between you and Kevin when we come on to shareholder reassurance questions. And the last one's actually a very fair question from Mike Wade. Was the cash crisis caused purely by excessive scrap rates, or were there other contributory factors?
So Not purely, but largely. So at this point in time, every single disc that is scrapped is a lost sale. So that naturally loses us the revenue from the sales, and it significantly increases our costs. So what we've experienced is significant hurt from very low yields. But it's not the sole factor, as you've heard from Stephen. The capacity of our machines, making them available, and reducing cost is also important in other areas too. I think I also saw that individual ask about what do we need in terms of production yield, and for normal runnability and in our business plans by the end of December 2025, it's 95% yield, and that is absolutely brilliant for steady state, and that's our roadmap to get us there. I was just going to add, it is more important to get it right first time when we're aiming for 99. However, we've been cautious in our outlook in terms of steady, but certainly driving that improvement in yield.
Okay, and that need to get to 95% is a nice segue to bring Stephen in and start asking some of the questions on the operations. And I'd like to start with the one that the most fundamental of all, which is asked by Andrew Chollerton. I now worry whether your technology can ever be scaled for large-scale production. Are you able to comment on this? Stephen, can we make it in volume?
Yeah, I mean, absolutely. I mean, obviously, I'm fairly fresh to the business, but I mean, what I do have a bit of a pedigree in, I guess, is heat treatment processes in general. I mean, I worked for 16 years with SGL, so I know carbon fiber, the heat treatment process, Panox, which is a raw material, and that's where some of the significant challenges have been in the past. And you can sort of think of our process in largely two steps, where you've got the heat treatment processes and then the machining and assembly processes. I think, in understanding the challenges and then resolving them, we know where the strengths lie. We also know some weak spots. So when we look ahead at future technologies and we look to scale up the business, it's not always going to be a copy-paste approach. And I think we're doing our due diligence in terms of factory acceptance testing and site acceptance testing and all of the specifications through the whole RFQ process, and specifying the equipment, and then checking and making sure it's capable, that we stepwise do everything we possibly can to risk mitigate equipment coming on stream. But I think we've got a really good foresight of that. And as I say, with a lot of the equipment as well, because you talk a year or 2 years in advance, we've got to lock that in quite far in advance. And I think maybe there's one other comment that probably isn't that well understood either. It's a very long process. And inevitably, to find the sweet spot, the production sweet spot, in terms of the process conditions that we need, the temperatures, the residence times, and so forth, it's an iterative process. And by that, I mean, we've got to go through the process of producing a disc almost to the end before we can test it fully. And then we go back to the start again. And that can take not just weeks, but months, because some of our heat treatment processes are sort of 7, 8, 9 days, for instance. So that's why we've also baked this into the financial forecast. When we look at the big new piece of equipment coming on stream the end of this year, we've assumed 6 months of progressive improvement before we reach a position where we say it's fully industrialized and commissioned, and we've checked those boxes.
On that, there's a question that's actually come in on recently in the last 5 or 10 minutes, actually. So can you comment on why the scrappage rates have been so high? Is it equipment problems? Is it staff? Is it learning curves? From Andrew Chollerton.
Okay.
Give us more confidence if we knew more about why the issues occurred.
Yeah. Some of it's a bit of product mix. So it's kind of, there's more of a recency effect in terms of the scrap build through the year. So although we've given an average, it kind of, it develops as we produce more discs. The pain is felt higher as well, of course. Good thing with the data that we collect is we collect a lot of it, and it forms a certain pattern. So when you cluster the defects, they fall into certain umbrellas or categories. And there's a few large ones amongst that. And I think I explained that in the slide deck, that there's a top 5, and we address all the top 5, and we get down to a number that's somewhere close to 15%. And And then you're into the sort of longer tail of quality issues. That's also why we've taken a bit of a conservative approach on scrap, where we're not saying we're going to get the same jump that we've had in Q1 every single quarter, but we certainly get a good improvement in the first phases. And I can say that with some confidence from the point of view that we've seen that improvement, not just towards the end of Q1, but actually through the months of January, February, March. And the dials that got us the improvement are very much those. They're dials. We can turn it off and on, which is not always. It's not always as easy as that. But in that instance, it has been, which is great. So we have confidence that we've resolved the issues. We've got repeatability to give us that confidence. And then looking ahead, there is still one dominant scrap reason that we're looking to address, and we have seen some positive improvements in the chemistry part of it, if you like, without getting into too much detail. But it's still early days, so too early to commit, but showing some improvements and some promising signs.
Okay. A question from Andrew Boyle. Do you have the skills and resources required to fill the commercial contracts? I mean, are we able to get the skills? This is a question I get asked quite frequently.
Yeah.
Are the skills available in Knowsley, in the Liverpool region, in the Northwest to provide to do the job?
We believe so. I mean, there's no denying with any scale-up business, you get a fairly large influx in new heads. So we've grown to a business now of around 170 employees. I think we probably ended 2022 somewhere around 60 to 70. So it's quite a large influx of new heads into the business. There is some regional benefits. JLR, for instance, we've got a lot of big automotives that are on our doorstep. And some of our employees have got a history, if you like, in their CVs and their past in automotive. So they're not hitting the ground from a zero set point or a standpoint, if you like. They've got an element of knowledge and understanding. There is obviously an onboarding process, so someone takes some quicker than others, obviously, to get up to speed to understand our specifics about our process. We've also recognized, I guess, that we needed a bit of a change, and we did have a shake-up, you would say, in January in terms of the resource around accountability and how we distribute the workloads and who owns what. Two biggest changes, I guess, we had made was around the heat treatment process, and maintenance. So maintenance was looking after the entire site end to end. Their responsibility now is largely the back end of the process and all this ancillary services and infrastructure for the site. The heat treatment process specifically look after furnaces. We are definitely seeing a really good benefit by carving out that process, because it is somewhat of a specialist niche process. And also, if there's any technical skill set that we may have struggled in, you would say it's there. But we employed 2 additional heads into the sort of core heat treatment team with a lot of good technical understanding, commissioning of equipment experience that form part of that team. And part of their responsibilities is to actually do some internal training. So we've got 4 of our internal technicians that are going through a training program process, and we're also looking for external support in that area. So I think we're putting the right spotlight and focus in the right areas, and we've got some really good technical talent to help us along the way.
Okay. Before we go on to, we'll give Stephen a bit of a rest for a minute, because there's a number of questions come in on that relate back to finance, and I just want to go back to Isabelle on a question from Nigel Guest. Did I understand from the presentation that the Liverpool CapEx loan cannot be used for the 3.5 million CapEx, i.e. no retrospective claims? And I think you just need to explain that as part of the negotiation, we just changed the cash profile advantageously, but you will answer it better than I can.
Yeah, so he's right that there are no retrospective claims. It is all forward facing now. And the reason I really like this one is that it's actually, we don't even have to make the payment to our supplier and then reclaim it. It's a very in the moment, where against an approved invoice, the invoice will get paid directly out of the loan facility. And then obviously our debt increases. So it's all forward facing, and it's 100% of every capital approved investment for growth loan over the next 2 years. there's no retrospective claim.
I'd like to move on to some customer commitment questions, which I'm going to ask Kevin to take. And in some respects, there's three here, and I think it might be easier to ask all three. Forgive me for a minute. Ask all three as a single question, as it were, and then give Kevin the opportunity. Alan Morris, have any customers threatened to cancel orders due to production delays? Patrick O'Brien, update on customer commitment, please. Nathan Grigg, what measures are being taken to ensure you don't lose customers? Kevin, can you just flesh that out?
Yeah. Perhaps if I just, to answer that, take a little bit of a step back and say, and understand the relationship between customer and supplier and tier one supplier. With a complex system, as I mentioned at the start, a braking system there's 2 to 3 years of system integration that goes on, and there's a period before that of advanced engineering that it requires a huge investment from the vehicle manufacturer alongside the support from the supplier. What that really means is that the two companies are wedded together in a partnership. And it's I'm not saying it's unheard of, but it's very difficult and very costly in terms of money and time for a vehicle manufacturer to change course, to change what technology or what products they put on the car. It's why those relationships are so important. So has anyone cancelled any contracts? To answer that directly, no. It would be a huge decision for any customer to make because of those elements of cost and time. What tends to happen when you're going through this scale up and you're introducing a new technology with a customer is they want to work very closely with you. So they are familiar with the challenges of scale up with disruptive technologies. They've done it before, so they come to it with a lot of experience on how it's done. They don't come with the technical experience on each individual product because that's very much the domain of this tier one supplier. So their approach is very simple. It's what resources can we supply to you? What information? How do we help you get to where we all want you to be? And that isn't a threatening situation. That's a collaborative partnership situation. So we've worked through that over the past sort of 6-9 months or so, probably even longer, where they've worked with us. They've understood what our challenges are. They've understood what our output is and our capacity. And then what they can do is then look at how they introduce that in terms of that capacity that we have for the contracts that we're supplying. So they've rescheduled their demand, looked at how their timings are. So it's not necessarily, it is a phasing difference in terms of how we introduce it, rather than a binary situation of contract cancellation. And because everyone wants us to get to that point where we have the capacity, we're able to supply at the volumes that everyone wants, and then everything will be in a stable situation. So that's the objective of the OEM. That's the objective of us. So we're all aligned, and they support us where they can.
There's another question, which is a market one that's come in the last 5 minutes from Martin Ligg on market size. How do you, I think it's Ligg, LLG. How could you explain how you come up with a 2 billion market opportunity? How big is the total market?
So that the way we define the addressable market right now is we look at ceramics are in the performance luxury end of the automotive market. So just to remind everyone, that segment we're in is probably less than 1% of the overall brakes market. So it's a really tiny piece of it. But we look at cars above £100,000 because ceramics are not as low cost as an iron rotor. So cars above 100,000, we think everyone will adopt it on all four corners. That's been the trend. And cars between, say, 75,000 and 100, they'll adopt it on the main braking axle, which typically is a front axle. So we can add up all those cars produced by those high performance luxury car manufacturers, and then we times it by an average selling price, which we don't sell it at that today, but it's a sort of forward-looking average selling price. And when we do that, it comes out to be north of 2 billion. So that's really how we define it. We're only looking at that very, very, very small segment at the top. The next piece of it will be, how does that develop? And normally these things start to trickle down beyond the 100,000 and the 75,000 into cars of lower retail value. I'm sure that will happen, but right now we'd be very happy to take on that £2 billion market. Now, to give you an idea of the adoption and the penetration in that market, obviously Brembo, our competitor, is the main player there. Their sales are in the region of 2 to 250 million. So they've got a significant part of that market, and they are being challenged to grow as well as that adoption curve continues through that £2 billion market. So I know they've got an investment plan of 170 million euros to increase their capacity from where they are by another 70%. And obviously we've got our contract wins of 390 million, equating to circa 80 million a year, which is where we are going with our contract wins and capacity plans that we're putting in place. So that adoption curve, we're still in the sort of first 25, 30% of that adoption curve, but that's where it's going at the 2 billion.
The other one, which I just want to move on to just give Stephen, is from Charles Breeze about, could you just flesh out the sort of changes that have been made in management? Because I talked about this is a new team, and it's quite important to emphasize in the last 6 months, the new team under the new team. And perhaps, Stephen, you could just talk a little bit about that.
Yeah, sure. So part of the changes that we made at the start of this year, aside from the heat treatment and maintenance team, was to look to change some of the responsibilities within the senior leadership team as well. So we had a new start, if you like, that joined the team just prior to myself, actually, in August timeframe, looking after manufacturing technology. So in a recognition, if you like, that within the business, we had a growing need for sort of process engineering and manufacturing engineering skills, as well as a project management office or a PMO. And really their responsibility is to look after the capital spend, to make sure we spend the money as wisely as we can and safeguard ourselves against that. And also the process engineering team, if you like, is obviously looking after the day-to-day equipment process type improvement. So that was something that the business didn't have carved out as a responsible in its own right, if you like. And then we've got Kerry looking after our operational piece, if you like. So she's very much looking after the day-to-day operations of the business, and that sort of change in responsibilities within the team. And we've also got a change around the responsibilities also within the quality team, and created what we call a cross-functional team. So there is a little risk sometimes of companies falling into a bit of a silo mentality where each department looks after their own defined responsibilities. But often our challenges are broader than that. So it crosses over quality, process engineering, and operations. So we've recognized that and kind of carved up the process and allocated individuals to have that sense of ownership and accountability for each of their areas and the respective areas. And I think that's helped us be more responsive, and we need as a business obviously a lot of agility to respond to the various demands that we have and the scale up process. So I think we've got the right kind of individuals around us. We've got the right kind of headcount, given where we are and where we're projected to go for the rest of this year. It's about getting on with the job and getting it done.
There's another question, and I think it's an important one, really. It's just come in literally in the last 10 minutes. I'm going to ask Kevin this one. What percentage do you think, but it's known that we introduced a savings scheme, a shared incentive scheme, that requires employees, this isn't options, it has an element of options and a savings scheme, but it requires employees to put their hands in their own pocket to buy the scheme. And question mark from this anonymous, what percentage of employees are enrolled onto the company shared incentive scheme? Kevin?
Yeah, well, it's a really good question. I think when we rolled it out, we were hoping that we'd get a signal from the all the employees of how committed and engaged they are with what we're doing, and we got a really strong response. So the answer to that is I think it's 43% of people are participating in that scheme. To put that into context, we asked what would be typical for participation, and we were told typical values are around the 10% mark. So we were delighted with the commitment and the attitude and the response from the employees on joining that scheme and voting to back themselves and the rest of the company.
And I think it's an important point to make that and we completely, utterly understand the anger, the frustration, the bitterness of shareholders as to what's happened in the last few months. And by the way, we might be directors and all the rest of it, also shareholders. I suggest you all look up in last year's annual accounts how many shares I've got, and therefore how much money I've lost in the last 3 weeks. We are both, and by the way, everyone on this, another question, I can't remember who it's from now. Is everybody on this call a shareholder? Are they all? In fact, read the prospectus. All the board and Stephen are investing in this in fact, placing subscription, whatever you want to call it. We're not allowed to subscribe in the open offer as it happens. So that moves us on neatly to they're all participating in the placing. We moves on to some of the wider questions that have come from shareholders, because I realise we have and it's one from Paul Roberts. Can you give us any hope, please, Kevin?
Yeah. So this is where I would, I'd remind everyone that we have challenges on our scale up, but if you just look at the fundamentals and say, look, we've got a fantastic product, and that's not us saying that. That's our customers who've done all their engineering and testing and awarded lots of contracts based on that product performance and the quality of that product. We've got some world-renowned customers, some truly world-renowned names who have signed up to do all of those contracts with us. We've got a brilliant position in the marketplace in terms of having a superior product than our competitors and being competitive against those guys in terms of pricing and cost of manufacture. And we have, I'm hoping you're getting more of a flavour with the introduction of Stephen and Isabelle and the other members of the team. We have a really committed, fantastic team that's determined to make a success of the company. And that gives me the hope, and I'm hoping it gives everybody else some signs that it's easy to focus on what we're not doing, and but there's a lot of stuff that has been achieved and shouldn't be discounted.
To which I'd add the commitments perhaps the wrong word, the support we've had from customers over the last 18 months, 2 years of misery.
Yeah.
And they've been with us. Not maybe been with us, they've literally been with us. They've been all over the factory and sitting and working with. Let's move on to a generic question. A general question, and it's asked by a number of shareholders. Jeff Jones, after approximately 19 fundraisers, when will the 20th be required? Peter Gray, can you provide any assurance about further fundraisers to the near mid-term? But basically, is this it? Kevin, you kick off, and you might want to get Isabelle to comment.
Yeah. So, look, we recognise certainly the last one and the one before we had our plans in place that would effectively get us to our cash break-even position, whether it be on EBITDA or cash generation, and that hasn't happened. And our forecasting, in particular, has probably been more optimistic in terms of what we could achieve. We've looked at this time and we've pressed the reset button, and that's part of the reason why we've created a range for our forecasting this time and said we've got an upper and lower case for our forecasts, because we recognise there's still work that needs to be done. We are improving the likes of yield, cost reduction, process changes are coming down. All those things are giving us the trends that we're looking for and the key performance indicator we want, which is giving us that opportunity to say, right, we believe this is the last time we need it. And then we've said, well, let's try and make sure we've got some headroom in there as well. And I know Isabelle's already talked about that headroom, but we then looked at it, and Isabelle will probably give more on this, but we've done multiple different sensitivity scenarios where we try to understand if certain things don't happen on time, if certain things don't come through, what would that mean for the business? How would we manage that? And we've done a huge amount of work, or Isabelle certainly has, on looking at that modelling and looking at trying to understand how all those different dynamics work in a complex system like ours. So I think all of that work is there to allow us to decide and to make some guidance that we believe in, and is more prudent perhaps than we have done in the past. So we've tried to be less optimistic and more pessimistic, and that's what's led us to talk about range rather than an absolute number.
Isabelle, do you want to add anything to that?
I think Kevin's nailed it. I think you're absolutely right. Whilst we've got all that good stuff in terms of a great product and customers and team and equipment, we've learned of the dynamics of the business. We've got our arms around it. We've based on everything and all our scenarios based on the information we know today and what we need to do to really drive that performance. And the reset button is really important. It's important for our shareholders and investors to understand the risks, which I hope Stephen and I have shared today. And with that risk, it means it's not an easy path, but actually there is a roadmap to achieving financial stability. And I do believe we can get there, yes.
There's a question from Simon Bailey. I was tempted to answer this myself, actually, but I will pass it over to Kevin. It says, as a long-term shareholder, I've seen 98.5% of my capital eroded. Why should I provide you with any more funds? And I'm going to answer this not as the company's chairman. I'm going to answer this as a shareholder. And the answer is, I believe, and you either do believe or don't believe, that we will get through our operational problems. It might even take us a little bit longer than we've said, as thank goodness we've got a buffer. Might be things that happen. But we're now at a price that is utterly ridiculous. It bears no relation to any sane valuation of the company. And therefore, investing in the company now cannot help but produce a return on that. And I can only say for myself, I was pleasantly surprised when I did the numbers. At the very least, investing at that silly penny price has an astonishing, almost brought me back to my original percentage shareholding in the company. In simple terms, it's right now, it's a good investment. Kevin, I hope I haven't stolen your thunder.
No, I just share that pain as well. I think the share price is totally disconnected from the actual value of the company, because the focus is on what are operational challenges rather than the strategic position that the company's in. I'll come back to it. We have an order book of 390 million. We have a product which is world class. We have a customer list that people would die for. How all of that is not recognized in the value today is something that only the city can comment on, really. We don't recognize that, and as you say, then the flip side of that is that if we don't recognize that, then arguably it's a good investment because we believe it's completely undervalued.
By the way, there was another question came in. Is there what's about the whole board, the NED's attitude towards this, and all the NEDs invested, and in fact Matthew invested quite a considerable sum indeed. But look, I think we've covered all the main issues. I mean, there's lots and lots of very specific questions, but the issue is that a number of the questions essentially cover the same theme. I don't want us to just ask questions for the sake of asking questions. And I'm going to conclude it almost with a technical point, a technical question that's been asked by, is it Tom Trudigan, about how the open offer system works. And because it would give me an opportunity to make a comment about the 2 million and 3 million and explain what there are two numbers in the prospectus. The question for what's the record date? The specific question is what's the record date for the open offer, and if I buy shares, does it help? The answer to the question, no. And I think the offer date, remind me, Isabelle, was it the 10th or something, or whenever it was? It was
the 1st of May. Sorry.
Anyway,
I think it was
the offer
the
date
1st of May,
passed.
wasn't it? Yeah.
Sorry?
Was it not the 1st of May? I'll check that behind the scenes.
Yeah, the offer. Yeah, just check it. The offer date, the record date is passed. So the number of shares you had on the record date, which was a few days ago, is the basis of the shares. You will get your rights regardless. If you apply for them, you'll get your rights regardless of what the total offer is. Buying shares now doesn't help. Selling shares now doesn't make any difference. So you will get your offer based on that. And that has been based on an open offer value of 2 million. It is not unknown, forgive me, for the open offer for people to apply. You're allowed to apply for shares in excess of your basic entitlement. And I advise people to do that. I mean, make their own mind up. We therefore are saying that although the rights issue has been based on 2 million, we reserve the right to go to 3 million. And that will then create an excess. If it goes to 2.6 million, everybody will get their excess. If it goes to 3.6 million, we're not going to go more than 3 million. And we will then have a scaling back process in some way, which we will talk to our advisors depending on the scale of the open offer. So I hope that deals with Tom's question. And
David, just to confirm this with certainty, the record date is the 1st of May.
1st of May, okay. I knew it was a few days ago. I hope that's answered all the questions. Answered all the theme of the questions. I certainly haven't answered all the questions, which is, I see 63 today and 100 over the in advance. But we've certainly, I feel, answered all the themes of the questions. But you basically, you know how to get hold of us. Please do so. The website will be going on the afternoon. There will be now we're going to drop off. There's a questionnaire on what you thought of us, of the presentation, and how you now feel about the company, which will be administered by Hardman, and they will let us know. It's not going to come to us. They will let us know what you say. So I do urge people, people who are still on, and I have to say I'm delighted by the number of people who are still on. It's over 100. I urge people to take part in the questionnaire. I thank everybody for an hour and a quarter's attendance time. I hope you take part in the open offer. I urge you to do so. We believe in the company. We continue to believe that we can get there. It's been a painful and difficult process for which we're all feel badly about. And thank you very much. Let's leave it at that. I suggest we ask Hardman to now close down the participants, but leave the questionnaire open. Thank you, everybody.